Good afternoon, everyone, and welcome to this Oxford Economics webinar. My name is Martin Beck, and I'm a UK economist here at Oxford Economics. I'll shortly be joined by my colleague Andy Goodwin, who will take you through the economic implications of the election and its aftermath. Just before we get started, a few housekeeping points. Andy will provide a 20-minute or so presentation, and will then be taking questions. If you would like to ask a question, there should be a drop-down box at the top of your screen. Please use the chat icon that is in the drop-down at the top of your screen and send a private message to our host, Adrian. This can be done throughout the presentation. Please could you also remember to stay on mute so there's no disruption during the webinar. Just to provide a brief background before Andy begins, we've got the last pre-election budget out of the way 2 weeks ago, and the general election campaign is now in full swing. As part of that, fiscal policy will be a key battleground between the political parties. So it seems like a good time to talk now about what the fiscal plans of the respective political parties might mean for the economy over the next 5 years. Pre-election budgets have typically been full of giveaways to favourite groups in the electorate. That said, the nature of the recently ended coalition government made March's budget something of a novel one, with the measures announced by the Chancellor requiring the agreement of both the Conservative and Liberal Democrat partners. But what did the budget's announcements imply for the UK outlook? Well, I'll now hand over to Andy to explain.
Thank you, Martin, and good afternoon to you all. When he was interviewed on the Andrew Marr show on the Sunday prior to the budget, the Chancellor George Osborne had promised there'd be no giveaways and no gimmicks. I think it's fair to say that on the first of those promises he was right. Certainly it was a sort of no giveaway budget at the macro level. But I think in terms of the gimmicks, there were plenty of those, and certainly that's something this Chancellor has become accustomed to. First of all, though, I think we'll sort of move back a step and think about the OBR's forecast, because as ever, the OBR's forecasts really provide the framework around which the Chancellor has to work, given the sort of framework that he put in place. Now, in terms of the OBR forecasts, I think it's fair to say we were a little bit disappointed. I think those of you who subscribe to our publications will know that over the course of the last 3 or 4 months, we've regularly identified the likely boost that the economy will get from lower oil prices and the sort of feed-through that may have. And we were certainly expecting the OBR to take a similar view and to upgrade their forecasts quite significantly. In fact, what actually happened is that their forecasts were barely changed at all. And in fact, all of these sort of boosts that the consumers were due to get from a lower oil price pretty much went into extra savings. So the OBR increased its estimate of the amount of income that consumers would have, and actually reduced its forecast for consumer spending growth this year. That meant that the forecasts overall for GDP were pretty much unchanged. And I think certainly if you look at the left chart on this slide here and compare their forecasts to both our own and that of the Bank of England as well, it's quite clear that the OBR are very much at the pessimistic end of the scale. Indeed, I think if you look at the level of GDP in the OBR's forecast in 2017 and compare it to the Bank of England's, you're looking at a difference of about 1.5 percentage points, which is quite a significant deviation over the course of just sort of 3 years. So I think in terms of sort of the forecast, the OBR were very gloomy. Now, part of that is sort of really that sort of idea about oil prices and them taking a fairly gloomy view on that. The other half is something that we've regularly sort of pointed to, which is their very pessimistic view on potential output and on the output gap. Now, the level of GDP was actually revised down a little bit sort of between their December forecast and their March forecast due to some revisions from the ONS. Yet they didn't change their output gap forecast, which actually implied a lower starting point for potential output. And then going forward, their forecast was barely changed from last time, which means that by 2020, they're expecting the level of potential output to be some 8% lower than would have been the case had the pre-recession trend continued. Now, if you go back through history, look at the literature, previous financial crises, that is some way above the experience that really any of the literature picks up from previous financial crises. So it is a very, very sort of pessimistic take on things. Just as a sort of point of comparison, our own forecast assumes that we're about 6% below, and even that is towards the top end of the scale of the experience of previous crises. So I think, yeah, really you're sort of looking at a pretty sort of pessimistic, pretty cautious set of forecasts from the OBR, which didn't give the Chancellor a huge amount of wiggle room. Now, I think certainly you could argue that it's good for the official forecaster to be sort of pessimistic. Certainly, it is better that the forecasts are are a little bit sort of on the downside, and that we overachieve, that then we continue to come up short. But I think the extent to which their forecasts are falling behind those of most people in the private sector, and obviously those of the Bank of England, it is sort of leading us to suggest that maybe they may be forcing the government down an unnecessarily austere path. Now, because there was very little change in the macro forecast, that meant very little change in the public finances forecast either. And that's really except the sort of ones that we already knew about, and that was really this idea that the debt servicing costs would be lower in the future because inflation was that bit lower than it was in December, and also because the markets had become more pessimistic about the outlook for interest rates. So there were sort of minor savings there, but by and large, you're looking at a fiscal picture that wasn't desperately different from where we were previously. Now, in terms of the Chancellor's fiscal rules, certainly the main rule, the so-called fiscal mandate, where he has to balance the cyclically adjusted current budget by 2017-18, the OBR still expected the government to achieve that relatively comfortably. But in terms of the other sort of parts of fiscal policy, this is really where some of these sort of gimmicks came in, some of these more cynical manipulations of the figures that are employed by the Chancellor really came to pass. Now, the first of these was regarding his supplementary targets. You may remember that back in 2010, when the current government came to power, they set up two targets for the fiscal policy. The first was the fiscal mandate, which gave them a 5-year window to balance the cyclically adjusted current budget. Since then, they've actually brought that forward and made it a 3-year window. But there was a second target, which for all of the period from Autumn Statement 2012 onwards, they looked like they weren't going to achieve. And that target was to have the debt to GDP ratio falling in 2015-2016. Now, just sort of really in the nick of time, with sort of some pretty handy timing, the government has decided to sell some of its very important assets over the course of the coming fiscal year, really to make sure it gets back on track. So it plans to sell £11 billion worth of assets that are held by UK Asset Resolution, effectively the state-owned parts of Northern Rock Asset Management and Burford and Bingley, and also £9 billion of the shares it owns in Lloyds Banking Group. Now, those together are just about enough to get the debt to GDP ratio falling, but without that, certainly that supplementary target wouldn't be met. So it really is a sort of a very sort of crafty sleight of hand from the Chancellor, and one which has pretty much no economic or fiscal relevance, but one which was really sort of aimed solely at trying to attract some relatively nice headlines for the government. Now, that was the first of his two sleights of hand of the budget. The second sleight of hand refers to what seems to have been christened now the roller coaster. That's an invention of Robert Choate, the head of the OBR. Now, the roller coaster is really sort of referring to the profile of government spending, and more specifically the profile of government's departmental spending over the course of the next Parliament. What the Chancellor did at the budget was that he tweaked his spending assumption for the final year of the Parliament, 2019-20, and actually added about £20 billion to the total that he planned to spend in that year. And as you can see from the chart on the left of this slide, he didn't really make much in the way of changes to any previous years. So what you have is this sort of one change in his spending assumption for 1 year of the forecast, pretty much dwarfing everything else that was announced in the budget. Now, there were two sort of factors behind this sort of big turnaround. First of all, there was this sort of need to neutralise what I think Labour called the Wigan-Peer sort of effect, which is effectively was this idea that the cuts announced in the Autumn Statement would take the level of day-to-day spending on public services to its lowest level since the 1930s. Putting a little bit of extra money into the pot there in 2019-20 took the Chancellor just above that sort of magic level, and meant that sort of criticism was no longer strictly valid. Now, obviously, it would have been much more sensible for him to actually wedge that money in more slowly, rather than have that very odd profile where all of it comes in at the end. But he's actually boxed himself into a bit of a corner because, as I mentioned earlier, he changed the terms of the fiscal mandate about a year or so ago, and actually meant that the government had to target balancing the cyclically adjusted budget by 2017-18 rather than 2019-20, which meant that he had to keep the very severe spending cuts in place in that earlier period, so he continued to achieve that fiscal mandate. And therefore, almost the only way he could then sort of neutralise that Wigan-Peer criticism was then to throw all the money into the later period. So what you have now is this very odd profile for departmental spending, which is shown in the right-hand chart there, where you have cuts in the first couple of years of the years 2 and 3 of the next Parliament, which are way beyond anything that we've seen so far, followed then in the final year of Parliament by the biggest spending splurge we've had for 10 years. Clearly a completely unrealistic assumption, and one that has very little chance of actually coming true. Now, I think sort of in terms of sort of how we deal with that in terms of our forecast, we've assumed that they may well get to the spending total they plan to in 2019-20, but they're much more likely to get there in a straight line, rather than that very odd roller coaster. And I think given that both sides of the coalition have actually disowned this sort of forecast assumption, I think that's a fair sort of policy to take. But I think what it also demonstrates really though is that sort of in terms of fiscal policy, we're really in a state of flux now until after the election, by which time the incoming government, whichever colour it may form, should give us a new plan to work from.
Thanks, Andy. So that rollercoaster budget is now passed, and Parliament was dissolved last Monday, which means that the election campaign has now begun in earnest. All of the political parties are making lots of noise about the merits of their respective plans, but how different would the macroeconomic consequences of those plans really be? And we'll now explore that in the presentation.
Thanks, Martin. Well, in terms of sort of the parties' fiscal plans, I think it's fair to say now they've probably diverged more than any time for several years. Certainly, I think if you look at where the parties now are now relative to 2010, things have diverged quite markedly. Now, the first sort of aspect in which they diverge is in terms of the fiscal rules. I think if you look at the three main parties, they're all looking at something that looks slightly different from one another. I suppose at the loosest end of the scale is the Labour Party. The Labour Party wants to balance the current budget, so that's day-to-day spending taken away from day-to-day tax revenues. They want to balance that budget, the current budget, by the end of the next Parliament. So that effectively sort of requires, based on the OBR's latest forecast, overall borrowing of just over £30 billion, with that extra chunk of borrowing being borrowing for investment projects. The Liberal Democrat plan by the end of the Parliament doesn't look desperately different, but I think in terms of timing, their sort of cuts or their sort of austerity is a little bit more front-loaded. They actually want to balance the cyclically adjusted current budget by 2017-18, which is consistent with the existing fiscal mandates. But they also want to then borrow to invest over the periods. So again, when we get to 2019-20, the end of the current government, again, you're looking at borrowing of just over £30 billion, according to the Liberal Democrat plan. The Conservatives want to go quite a bit further. So the Conservatives want to actually achieve outright budget balance by the end of the Parliament, and also obviously achieve the fiscal mandate in 2017-18. That requires a fair amount of austerity in the near term, and then continuing that sort of over the course of the back end of the Parliament as well, which means that by the end of the Parliament, borrowing is somewhere close to zero, and all of their spending, whether it be current spending, so day-to-day spending, or spending on capital projects, will be covered by tax revenues. Now, all of these plans are a little bit less severe than the current coalition policy. The current coalition policy that was published in the budget required the coalition to achieve a budget surplus of about £7 billion in the final year. But obviously, I think there's a very distinct scale sort of setting up here. The Conservative plan is a little bit less severe, and certainly the plans of the Labour and the Liberal Democrats are less severe by quite some way, and would actually imply quite a lot less austerity over the course of the next Parliament. The other way that the plans differ is in terms of how they actually plan to go about achieving that in terms of the sort of mix between tax and spending. The table on this chart sort of shows it in greater detail. I don't propose to go around sort of box by box and talk about all of these. But I think it's fair to say that the Conservatives are very much focused on the idea of cutting spending, so effectively reducing the size of the state. And in particular, their cuts are much more focused on cutting welfare, so cutting sort of the amount of unemployment benefit and various other benefits that the government pays out, in order to then give them a little bit more money to spend on government departments than is assumed in the current plans, and also to fund some quite large tax cuts as well. So the Conservatives would like to raise the income tax personal allowance from its current level of just over £10,000 to £12,500, and also ensure that people aren't paying 40% tax, but if they earn less than £50,000. So effectively, this is very much a sort of small state type policy. The Labour Party is much more about increasing taxes. So the Labour Party would like to tweak the income tax system. They'd like to reinstate that top rate of income tax at 50%. They'd like to reintroduce the 10% starting rate as well above the personal allowance. And one of their more high-profile schemes is also to include what they call a mansion tax. So effectively a tax payable annually on houses valued over £2 million. The Liberal Democrat plan is really a sort of a bit of a mix and match of each of the previous two. They are also quite keen to raise the personal allowance and sort of help the lower paid. But equally, they would also like to raise money from mansion taxes as well. So, I think there's a sort of a very heavy sort of redistributive theory kind of underpinning the policy of the Liberal Democrats. But I think the combination of very different fiscal rules plus this sort of different tax and spend means that the outcomes that we may see for the economy over the course of the next 5 years could well be very different. Now, this is where the Oxford model comes into its own, because because the Oxford model has the sort of a very detailed specification, not just of the sort of fiscal side of the economy, but also monetary policy and all the sort of interactions as well. What we can do is we can actually apply the sort of various policies of the main parties to our baseline forecast and see how the world would differ, sort of based upon each of those policies. Now, there's a lot more detail on how we've done this in the research briefing. There's a link at the bottom of the page to that research briefing, and subscribers to our global macro service can actually open that. But what the key results show is that over the course of the next 5 years as a whole, the Liberal Democrat plans would offer marginally the strongest GDP growth at around 2.8% a year, followed by 2.7% a year for the Labour Party and 2.6% a year for the Conservatives. So this chart here shows you the level of GDP across the Parliament, and you'll see there's not a huge difference between the Liberal Democrats and Labour. That 2.8, 2.7 is sort of exaggerated a little bit by the rounding, but what there is quite a clear sort of premium in terms of the growth that you can achieve under those two parties relative to what's achieved under the Conservatives. And quite simply, that's because the smaller degree of austerity does much less damage to activity. Now, the Conservatives' retort to that would be that there are two benefits of their policy. One is that lower debt levels would give you greater flexibility in the event of an unexpected shock to the economy. And secondly, that if you had lower borrowing and lower debt, you would have to pay less to service that debt, and therefore the sort of money that you would otherwise spend on debt servicing could be spent more productively. But our scenarios here show that there's only very weak evidence to back that idea up. Certainly, I think if you look at the chart that shows debt on the left-hand side, the sort of reduction in debt that you get under the Conservative plans relative to the other two parties is pretty small. It's about 0.3 percentage points by the end of the Parliament relative to the Liberal Democrats, just over 1 percentage point towards Labour. Now, certainly, I think if we're thinking about how much flexibility that gives us in terms of sort of shock, and you think about, for instance, the size of the budget deficit we have now, you couldn't do much in the way of extra stimulus, really, if you were under the Conservative plans, much more than you could do under the other parties. It gives you very little extra flexibility at all. In terms of guilt, maybe a little bit of a sort of bigger difference between the various parties there. And certainly some of that is sort of really due to this idea that the markets would charge a smaller premium on a sort of a more austere fiscal policy. But I think that's much less important than the other sort of factor that tends to sort of determine where gilt yields go. And that's markets' expectations about the shorter end of the curve, and therefore their expectations about monetary policy. In terms of what happens in our scenario here, the differentials you see between the parties are much more reflective of the idea that the looser fiscal policy pursued by Labour and the Liberal Democrats would then invoke tighter monetary policy from the Bank of England, and in turn would sort of increase interest rate expectations in markets, and therefore gilt yields would be pushed up that way. So if anything, actually, the higher gilt yields under the Liberal Democrats and Labour plans are almost a reflection of the strength of the economy rather than a sign of weakness. Now, I think when you take these sort of charts together, sort of the GDP, the debt, and the gilt yields charts, I think our sort of view is it's very difficult to argue that the very small benefits you get from gilts and from public sector net debt being lower is anywhere near enough to outweigh the damage that austerity does to growth. And certainly the more pro-growth and less severe austerity plans do look much better options to pursue in terms of the UK's economic outlook.
Okay, so we've now looked at what the respective parties' plans might mean for the economy, but what do the polls actually tell us about the chances of those plans being realised? And will the election itself have an effect on the economy? So I'll hand back over to Andy to cover those issues.
Thank you, Martin. Well, I think in terms of the election itself, this is probably the most interesting and most open election we've had really since the mid-1970s. And I think certainly if you look at the recent polls and shown in the left-hand chart on this slide here, you have the two major parties, Labour and the Conservatives, really sort of with the weakest levels of support for quite some time, and quite a big rise in maybe some of the fringe or more minority parties, the likes of UKIP, the Green Party and the Scottish National Party. Now, there are some quite interesting dynamics going on everywhere. In Scotland, you've got the Scottish National Party sort of really riding on the back of the referendum there, and their outperformance, if you like, in Scotland. And they seem to be set to take quite a lot of seats in Scotland away from Labour. You've got the Liberal Democrats suffering really everywhere. It seems to be a sort of a reaction to their role in the coalition and a disappointment amongst their traditional support there. And you've got UKIP really sort of taking support from both left and right across the country, being sort of very successful in terms of appealing to very different members of the populace. But I think those polls are quite interesting, sort of showing the left-hand chart. But obviously what really matters in this country is the first past the post system, or what that actually means. And that means that we're not likely to see the level of split that those polls maybe suggest, with the two main parties polling sort of no more than 35% each. And I think the big losers from that first past the post sort of system, I think, are very much likely to be UKIP. So they may well be polling somewhere between 10 and 15% in terms of the national vote. But the UK system means that coming second everywhere has no meaning at all and no benefit. And pretty much most of the models that forecast the general election result suggest that UKIP will do well to get sort of maybe even 5 seats. So it's still very much a sort of fight between the big parties. But I think what the sort of the rise of the smaller parties has done is it's really started to eat into some of the sort of the numbers that the main parties may achieve. And certainly, I think if you look at the right-hand chart there, it looks like leaving all of the parties a long way short of getting an outright majority. 326 seats are needed for an outright majority. About 323 if you sort of take out the Speaker and take out Sinn Féin, who tend not to actually take their seats in Parliament. But if you average the 4 polls that we tend to monitor on a regular basis, you're looking at the Conservatives coming in at just under 290, down from just over 300 in the current Parliament. You're looking at Labour coming in at about 270, up only about 10 seats from where they were previously. And interestingly, the Scottish National Party looking at coming in at somewhere around 40 seats, which will be up from just 6 seats in the previous election. So it's quite obvious how much things have swung around. Now, obviously, we have a two-party coalition governing, have had up until Monday when Parliament was resolved. But it's actually quite interesting that the polls have split so much that we may not even be able to form a coalition government with 2 parties based upon the current poll. And I think of all the 4 models that we monitor, only one of them would take us past that magic 326 number, and then only just. And that coalition will be a Liberal Democrat Conservative one. But you can see that all of the other sort of coalitions shown on that chart, all the other sort of combinations of 2 parties, would leave us quite some distance short of coming up with an overall majority. And for that reason, there seems to be an acceptance now that we could well see the first minority government since the 1970s. Certainly, if you look at the odds by one of the well-known House Street bookmakers, I think this is quite a good way of looking at it. Obviously, this is reliant on people actually spending money and putting their money where their mouths are. Both of the sort of 2 most favoured options in the general election betting market now are minority governments, with Labour very narrowly ahead of Conservatives on that score. All other sort of various options, all other mixes of coalition have moved quite a long way out. So we could well see the first minority government since the mid-1970s. Now, if a minority government were to take charge, what they'd have to do is really come to an agreement, vote by vote, with other parties in order to gain support to actually pass legislation. Now, certainly that's something that here in the UK we haven't had much experience of recently, and it is something that I think people will be quite nervous of. Certainly, I think depending upon who these more minor parties are, you may well have to throw quite a few bones in their direction in order to get them to support. And I think the most obvious sort of ones that people are talking about at the moment are what would happen if you had a Labour minority government requiring votes from the Scottish National Party. Obviously, that would require potentially quite a lot of extra spending, maybe being channeled to Scotland, or certainly various other policies designed to favour Scotland in order to really sort of gain those votes to pass legislation. So it is potentially going to complicate things quite a bit. And what it does mean is, if you think back to the scenarios we presented a few minutes ago, it's very unlikely that any one of those individual scenarios will end up sort of coming to pass. I think what you'll end up with, probably based upon the current polls, is some sort of combination, some sort of mix of the various policies, and something that really is a compromise that is amenable to all. What impact could it have on the wider economy? Well, I think certainly there's been a lot of headlines recently about the potential impact on business investment. This sort of idea that the greater uncertainty about the political situation could cause businesses to sit on their hands till after the election, or potentially even longer, depending on who wins. But certainly, I think our sort of research suggests those sort of fears are probably overblown. If you look at a wider measure of policy uncertainty, and this is one that's produced by policyuncertainty.com, certainly the level of policy uncertainty is quite a lot lower at the moment than it was during 2011-2012 when the Eurozone crisis was at its height. And I think that sort of lack of uncertainty really is then sort of reflected in the relatively solid growth in business investment we've had over the last couple of years. So there's very little evidence of that sort of fear of uncertainty actually having much tangible effect. Indeed, I think if you look at the chart on the right, I think what's much more important is sort of the uncertainty about demand. And certainly, I think with the economy doing relatively well at the moment, better news coming out of the Eurozone in terms of GDP growth and activity there, firms are still pretty confident about the strength of demand going forwards. And therefore, I think certainly we're pretty confident that investment won't be hit so badly. In terms of sort of the impact on markets, I think it's very much the same sort of message in terms of gilt. We've looked here back at the elections of 2001, 2005 and 2010. And really use 2010 as a sort of barometer of what might happen if you have a relatively uncertain result. If you think back to 2010, what you had was what looked like a Conservative victory up until about 2 months from the election date. And then over the course of the final 2 months, you had the Liberal Democrats really sort of coming on charge and ending up taking enough votes to be part of the coalition. In terms of the gilt markets were pretty much unperturbed by that. There's very little in terms of movement in terms of gilt yields or in terms of the spread over German bonds in 2010 relative to any of the other elections. I think that the one sort of area where we do see some sort of some concerns is the equity markets. And certainly, I think if you look at the right-hand chart there and look at the red line, there is very much a sense that as coalition became more likely in the 2 months leading up to the election, there was an underperformance in terms of UK equities relative to the rest of the world. But I think what's also sort of quite noticeable there is that those equity prices then recovered pretty sharply past the election when it became quite obvious that we had a durable coalition and when it got very rapidly put into place. So I think in terms of sort of the election, the main messages are that I think it's very important that people get the coalition government or any sort of confidence supply arrangement in place pretty quickly. And if they do so, and if they're able to convince the electorate and markets that that's a durable agreement, then markets won't take fright in the way that maybe some people suggest they would.
Thanks, Andy. A lot to chew on there. We'll now move on to questions. We'll begin with a question about the modelling we've undertaken in terms of what the path of public debt might be under the respective parties' policies. So the question we've received is, well, why is it that the coalition plans apparently result in the highest debt ratio, even though those plans involve the tightest fiscal policy? It seems a bit counterintuitive.
Well, the charts that we've shown here are the debt level as a ratio of GDP and nominal GDP at that. And what we see through the coalition plans is we do see the debt stock coming down. But because it does such damage to activity in the economy, what you also see is nominal GDP being much weaker as well. So in terms of actually looking at that debt to GDP ratio, it really struggles to make the sort of dent that maybe it could do, just simply because the austerity is so severe, particularly in years 2 and 3 of the Parliament, where the sort of the downward slope of that roller coaster is at its steepest.
And the second question relates on a similar theme to gilt yields. Why is it that the coalition gilt yield profile seems so low compared to the other plans? Is that a reflection of a lower debt level, or what's the reason there?
Well, the coalition profile really looks lower because the sort of damage that this is likely to do to activity is so severe that it could well keep interest rates on hold for quite some time. You're looking at potentially GDP growth slowing to somewhere in the region of 2% a year from its current rate of sort of 2.5 to 3, and staying at those sort of rates for 2 or 3 years. Now, I think if activity were to slow into that sort of sphere, then what you would have is probably the Bank of England either remaining on hold for quite some time to come, or certainly increasing interest rates at a very, very slow pace. And though that sort of slow pace of interest rate normalisation would then also translate to the longer end of the curve and kick gilt yields down as well.
So we've had two questions actually about the issue of Brexit, of the UK leaving the EU following an in-out referendum. What would be the impact, do you think, on business confidence and GDP growth of the referendum or of the UK leaving the EU? Obviously a big issue, but maybe some initial thoughts.
Well, I think that the first thing to say is that I think the probability of a referendum has been quite significantly overstated. I think if we think back to the electoral dynamics and potentially the coalition dynamics, you only have one of the parties, the Conservatives, actually promising an in-out referendum. You have the other two main, or the other three of the other sort of main parties who may deliver enough MPs to make a difference: the Labour Party, the Liberal Democrats, and also the UKIP, and also the SNP. All of those are very much against this idea that we should have a referendum and are very pro-EU. So I think realistically, it's going to take either a huge U-turn from one of the other parties if they were to join in coalition or confidence in supply, or it's going to take the Conservatives to significantly increase their share of the vote over the next 5 weeks in order for a referendum to actually take place. I think the only realistic option really is for the Conservatives to actually have an outright majority. In terms of the actual question itself, I think again there are sort of concerns. I think that maybe the impact could be overblown. I think certainly if you look at the Open Europe report from a couple of weeks ago, which looked at sort of various scenarios around Brexit, the sort of impacts it was looking at were pretty small. I think if you look at a sort of time period out to 2030, which is where the report was going, the difference between the high scenario, the best outcome of leaving, and the low scenario, which is the worst, was less than 1 year's GDP growth. And I think when you're talking about that sort of impact over the course of 15 years, I think you're potentially talking about the Brexit maybe not being quite as serious an event as maybe some people may have you believe.
Okay, moving on to a different subject. There are a lot of headlines in the press at the moment saying that the Labour government, even the minority Labour government, would be bad for business. We saw the letter in the Telegraph today from 100 supposed business leaders. Do you agree that a Labour government would be bad for business?
Well, I think obviously today's letter, I think, is one of the sort of standard practices in an election campaign. It's very unusual for businesses to come out behind anyone other than the Conservatives, and I think today's letter was a little surprise. I mean, in terms of their sort of policies so far, there's a lot of anti-business rhetoric around there, certainly I think around sort of zero-hours contracts, around the potential impact interventions in the energy market. But I think in terms of the big macroeconomic policies that we look at in terms of our modelling, there's very few of those that would have a significant impact on the outlook. I think in terms of sort of Labour's plans for the fiscal rules, they're actually pretty loose. They sort of promise potentially stronger activity. You look at the impact around, for instance, the top rate of tax, and I think certainly the experience of the reduction in the top rate from 50 to 45% suggests that that's going to have very little impact in terms of revenues, and therefore shouldn't have much impact in terms of the economy either. And in terms of sort of corporation tax, yes, they're planning to increase the rate back to 21 from 20, but obviously 21 would still be significantly lower than we were at the start of this Parliament, and would still be comfortably the lowest in the G7. So I think certainly I think there could be a case that maybe their bark is worse than their bite. Okay,
another question. Without getting into the party politics, what do you think would be the best outcome of the election for the economy in terms of a majority government, a coalition, a minority? What's your views on that?
I think the experience of the last 5 years has been unexpectedly good. I think most people feared what we may have in terms of a coalition government, and we're very nervous about the potential for it to last 5 years. But I think most people have been pleasantly surprised by what it's actually achieved and its ability to govern. Admittedly, things have run out of steam a bit over the last year or two in terms of having legislation to pass. But I think generally the experience has been pretty good. Now, some of the policies that the larger parties are pursuing are fairly extreme. Things around the potential EU referendum, very severe austerity. Some of the more sort of extreme left-wing policies from Labour. So arguably, you could suggest that possibly some sort of coalition again between the right and the left may actually be fairly advantageous in terms of taking away some of the more extreme policies and pursuing something more, a little bit more mainstream. I think beyond that, I think a workable majority for one or other of the main parties is probably the priority. I think certainly I would be a little bit nervous in terms of minority governments, particularly if we are literally going vote to vote, because that sort of thing would involve significant bribes to all of the main parties, to all of the minor parties at regular intervals, and I think that's going to be a very difficult way to manage things.
Okay, we'll take maybe one final question. So under the Liberal Democrat and Labour scenarios we presented in our model work, do you have a clear enough idea of what we mean by productive investment? So what assumptions have you made about higher investment under Labour and Liberal Democrats actually contributing to growth? What counts as productive or unproductive in your view?
Well, I think what we've included in our sort of forecast is effectively the same investment levels that the OBR currently assumes for the current government, and that's really because neither of the Liberal Democrats or the Labour Party have actually explicitly said they would increase investment. All they've said is that they wouldn't cut spending to the extent where they'd actually have investment being covered by current revenues. So there's certainly that there is some potential upside to both of those sort of forecasts if those sort of parties were to go further and not just borrow to invest, but actually borrow more to invest than the current government would as well. Certainly, I think if you think about the model and how these scenarios play out, it's very clear that the investment spending has a much higher multiplier, i.e., £1 billion of spending on investment would do a lot more good for the economy than £1 billion of current spending or £1 billion less of taxation. So I think if they could convert their sort of plans towards more investment spending, then you could actually see an even better outcome still.
Thank you, Andy, and thank you everyone for your questions. I hope that's been an informative presentation for you and a good overview of what the election means for the economy and what might follow. We'll certainly be producing more analysis on this issue over the coming weeks, and I hope you'll have the opportunity to see that analysis for our global macro service. So thanks very much.